How to give the IRS instructions to settle all your debt. Commercial law and the illusion of money. 1. Introduction to negotiable instruments and jurisdictional challenges. The discussion opens with a focus on car financing and the simplicity with which negotiable instruments, particularly those recognized under the Uniform Commercial Code, UCC, can be used to facilitate transactions that appear to bypass conventional payment structures. The speaker asserts that while methods grounded in U.S. commercial law are effective domestically, their counterparts in other jurisdictions, such as the United Kingdom, may require adaptation due to procedural and judicial inconsistencies. Courts of lower jurisdiction, especially county and magistrates' courts, are described as administrative courts that resist recognizing higher principles such as constitutional or common law. Despite these barriers, individuals are encouraged to bring statutory and inferred commercial arguments into court, even if initial reception is dismissive. The Uniform Commercial Code, UCC, particularly Article 3, is identified as the controlling authority for negotiable instruments in the U.S., while the Bills of Exchange Act fulfills a similar role in the UK. Notably, the UCC distinguishes clearly that Article 3 applies to negotiable instruments and explicitly does not apply to money. According to Black's Law Dictionary, the process of settling accounts under commercial law does not rely on legal tender but rather on bills of exchange, drafts or orders to pay, facilitating transactions across distances without physical money. This distinction, though counterintuitive, forms the bedrock of the argument that money, as understood in constitutional or commodity-backed terms, does not legally exist within the commercial system. Footnote at these section introduces the fundamental argument that modern commercial transactions function entirely through negotiable instruments, not actual money, and that jurisdictional resistance is rooted in administrative court practices. 2. Categories of negotiable instruments and their legal character. Under the framework of commercial law, negotiable instruments fall into two principal categories: the unconditional promise to pay, known as a note, and the unconditional order to pay, known as a draft. The distinction lies in whether the issuer promises to pay, note, or orders another party to pay, draft. Examples of notes include signed traffic tickets, promissory notes for loans, and individual credit card transactions. These instruments constitute currency in themselves, each a self-contained unit of credit backed by a promise to perform. Conversely, drafts include unsigned traffic or parking tickets, utility bills, tax assessments, and judicial orders or judgments. These are not backed by cash in any traditional sense but are instead treated as transferable legal obligations. The speaker underscores a significant legal reality: in commercial law, the existence of money is a myth. All exchanges occur through instruments of credit rather than specie, currency, or commodity. This framework renders even high-value instruments, such as a court-issued judgment, functionally equivalent to a check or bill. The document is a demand for performance, not a reflection of real monetary substance. As such, understanding and identifying whether a document is a promise or an order to pay is the foundational key to interacting with the modern financial legal system. Footnote: this section outlines the two primary forms of negotiable instruments, notes and drafts, and emphasizes their legal equivalence to money within commercial law, despite the absence of tangible currency. 3. The role of endorsement and the status of the holder. Central to the use of negotiable instruments is the concept of endorsement and the legal role of the holder. A person becomes a holder when they possess an instrument that is either payable to them or payable to bearer. Once in possession, the holder may legally negotiate, endorse, and tender the instrument to settle obligations. The speaker illustrates this process vividly using a hypothetical courtroom demonstration. If one receives a judgment ordering payment, say, $480 trillion, that judgment itself is treated as an unconditional order to pay, i.e., a draft. Upon accepting the draft, the recipient becomes the holder and gains the right to endorse it. The demonstration includes a detailed verbal record for the court transcript, where the instrument is endorsed using a qualified endorsement, e.g., without recourse, and a special endorsement, e.g., pay to the order of U.S. District Court. The endorser then tenders the instrument back to the court, thereby completing the commercial cycle. This tender, legally speaking, constitutes a performance of the obligation. The transaction bypasses money altogether and relies instead on lawful commercial performance under UCC Article 3. By understanding how to create and execute endorsements, the individual discharges debt not with funds but through lawful procedure. Footnote: this section explains how legal obligations can be discharged through endorsement and tender of negotiable instruments, using a courtroom judgment as a practical example of commercial performance. 4. Payable to bearer, the default rule in the absence of a payee. A crucial but often misunderstood feature of negotiable instruments is the default rule regarding payee designation. Under UCC Article 3 and the Bills of Exchange Act, when no payee is explicitly named, the instrument becomes payable to bearer by operation of law. This means that the person in physical possession of the instrument is presumed to be legally entitled to enforce it. The speaker illustrates this with examples including Federal Reserve notes and British pounds. Despite being used as currency, these notes do not state pay to the order of anyone. The absence of a designated payee means that anyone who holds the note is automatically its legal bearer. This principle also applies to checks that lack a proper payee designation or include ambiguous markings such as initials, symbols, or abstract endorsements. This concept becomes particularly powerful when dealing with court judgments, tax bills, or traffic fines. If these instruments fail to name a specific payee, they default to bearer status, thereby granting legal standing to the recipient. Such status empowers the bearer to endorse and negotiate the instrument without further legal justification, creating a commercial advantage grounded in statutory interpretation. Footnote: this section highlights the legal default that renders instruments payable to bearer in the absence of a named payee, allowing the holder to assume full legal authority to enforce or settle the instrument. 5. Endorsement types and their legal effects. Commercial law recognizes multiple forms of endorsement, each carrying distinct legal implications. The blank endorsement, which consists of merely signing the instrument without specifying a payee, transforms the instrument into one payable to bearer. This means anyone in possession of the instrument is authorized to enforce it. The blank endorsement is the default form when no additional terms are stated. In contrast, a special endorsement explicitly identifies the payee, e.g., pay to the order of Rocket Mortgage LLC, and restricts enforcement to that party. An additional layer of protection may be added through a qualified endorsement, most notably by including the phrase "without recourse." This phrase limits the liability of the endorser, disclaiming responsibility if the instrument is dishonored due to insufficient funds or other defects. Real-world mortgage endorsements reveal consistent patterns. Mortgage lenders routinely employ qualified and special endorsements when transferring promissory notes. For instance, endorsements may read, "without recourse, pay to the order of mortgage company, by authorized signatory." This practice reinforces the legal understanding that such instruments are transferable not because of money, but through authorized commercial acts. The combination of a blank, special, and/or qualified endorsement governs who may enforce the instrument and to what extent liability may be attributed. Mastery of these distinctions enables the holder to control the commercial trajectory of the instrument with precision. Footnote: this section classifies endorsement types, blank, special, and qualified, and explains how each shapes the legal status and liability of negotiable instruments. 6. The legal power of without recourse and its commercial implications. Among the most powerful tools in commercial law is the use of the phrase "without recourse" in endorsements. Legally defined, this phrase disclaims any liability by the endorser to future holders of the instrument. In practical terms, it severs the endorser's financial obligation, even if the instrument later proves uncollectible or dishonored. Yet, paradoxically, the amount stated on the instrument remains valid and enforceable as a credit offset. The speaker emphasizes that a check written for $10,000 from an account containing only $1, when endorsed without recourse, is still deemed valid in the commercial system. The reason lies in the functional nature of commercial law. value is not derived from the account balance, but from the proper execution of the negotiable instrument. It is the endorsement, not the underlying funds, that activates the credit. This principle applies equally to checks, drafts, and promissory notes, provided the endorser is not the original issuer. If the endorser is the maker or drawer, the UCC restricts their ability to negotiate the instrument. Therefore, receiving an unconditional order to pay from a third party, such as a utility bill, IRS notice, or court judgment, grants the recipient lawful holder status and opens the path to endorse and tender the instrument back for discharge. Used correctly, without recourse transforms instruments into powerful commercial tools, legally shielded from future claims and enforceable as payment under Article 3. Footnote. This section explains how adding without recourse to an endorsement limits liability while preserving the enforceability and value of the negotiable instrument in commercial law. 7. Why creating your own instruments is legally risky. While it may seem empowering to draft one's own promissory notes or bills, doing so without a clear understanding of issuer liability introduces serious legal limitations. According to UCC Article 3, the person who initiates or issues a negotiable instrument becomes its maker or drawer. Once that role is assumed, the individual cannot later negotiate or endorse the instrument for discharge, as one cannot be both the obligor and enforcer under the same commercial contract. This presents a critical barrier. A self-created promissory note, though technically lawful, is non-negotiable by the person who created it. The proper method for executing commercial remedy, therefore, involves acquiring an already issued unconditional order to pay, such as a tax bill, traffic fine, or court judgment, where the individual is a third-party recipient, not the original issuer. In that case, the person receiving the instrument becomes the holder and may proceed with endorsement and tender, discharging the liability entirely under commercial law. The speaker strongly discourages cooking up one's own instruments and instead recommends actively requesting bills from agencies, creditors, or courts. Once a legitimate bill is in hand, the commercial remedy can proceed without limitation. Thus, the legal and strategic takeaway is clear: always act as the holder, never the maker, when seeking to settle liabilities through endorsement and tender. Footnote. This section cautions against self-created instruments by explaining how issuer status legally prevents negotiation and highlights why only third-party bills can be lawfully discharged. 8. Bills, drafts, and the demand for performance. In commercial law, a bill, draft, or unconditional order to pay is functionally identical. These instruments represent a demand for performance rather than a request for monetary payment in the conventional sense. Understanding this equivalence is vital for navigating administrative and financial liabilities. The speaker asserts that individuals should actively seek to receive bills rather than warnings, notices, or phone calls from creditors or agencies. Once a bill is received, the recipient becomes the holder under UCC Article 3. As holder, they are empowered to endorse the instrument, ideally using a special and qualified endorsement, and then tender it back to the entity entitled to enforce it. This act of tender satisfies the requirement of performance and discharges the obligation. The terms bill, draft, and bill of exchange are not only interchangeable but also share the same legal consequences. A check is a specific type of draft that includes routing and account numbers, thereby subjecting it to both Article 3 and Article 4 of the UCC. However, even if these numerical identifiers are removed, the underlying instrument retains its legal character as a draft. Therefore, any statement, order, or document demanding payment or performance becomes, in essence, a negotiable instrument, provided it meets the definitional criteria. Once it is received by a third party, it enters the commercial realm and becomes enforceable under Article 3 through endorsement and tender. Footnote. This section clarifies that all formal demands for payment, bills, drafts, or orders, are legally interchangeable and become enforceable instruments upon receipt by the holder. 9. The legal nature of checks and their commercial reclassification. A check is a narrowly defined legal instrument, a draft drawn on a bank that is payable on demand. According to UCC Article 3, a check qualifies as a draft and is thus an unconditional order to pay. However, because it is also drawn through a financial institution and typically contains a routing number and account number, it falls under the purview of UCC Article 4, which governs bank deposits and collections. Despite its financial appearance, the legal identity of a check is rooted in its function as a negotiable instrument, not as money. The speaker notes that if the routing number is removed from a check, it is legally reclassified. It no longer qualifies as a check under Article 4, but it remains a valid draft under Article 3. Thus, even without a banking function, the instrument retains its full commercial viability. The implication is profound: checks, like other drafts, do not require actual funds to be considered valid in the commercial system. What matters is form, not substance. As long as the instrument contains an unconditional order to pay and satisfies the requirements for negotiability, it may be endorsed and tendered for discharge. This distinction emphasizes that checks are not money, but lawful commands to perform within a commercial framework. When this framework is understood, checks become tools for legal remedy rather than merely instruments for transferring bank funds. Footnote: this section redefines checks as commercial instruments under UCC law and emphasizes their validity even when stripped of banking identifiers, reinforcing that function overrides form in negotiable instrument law. 10. Courts as banks and the commercial settlement of legal judgments. Modern courtrooms, especially those functioning as administrative or statutory venues, often operate under commercial law principles, whether acknowledged or not. The speaker emphasizes that a court judgment constitutes a draft, an unconditional order to pay, which qualifies as a negotiable instrument under UCC Article 3. If issued by a clerk or magistrate, the judgment acts as a commercial directive commanding payment. Importantly, courts are not just adjudicative bodies, they often function as depository institutions in practice. When a judgment is issued, it can be tendered back to the same court, effectively performing and discharging the obligation. The act of endorsement and tender, when executed with the appropriate commercial language, serves as lawful settlement. This aligns with the principle that courts can operate as banks when they receive and discharge negotiable instruments. This reality is not symbolic, it is functional. Clerks act as receivers, and their documentation mimics the processing of a financial draft. The judgment, once endorsed with a qualified and special endorsement, e.g., pay to the order of U.S. District Court, without recourse, becomes a completed instrument. It then exists in the court record as settled, not by payment in fiat currency, but by commercial performance under law. This approach reframes litigation from a punitive process into a commercial exchange, where debts and claims can be settled by informed legal performance, rather than adversarial contestation. Footnote: this section reveals how courts can act as commercial banks by receiving endorsed judgments as negotiable instruments, enabling lawful discharge through performance instead of currency. 11. Understanding dishonor and its role in commercial default. A foundational element of commercial law is the principle of dishonor, which occurs when a party refuses or fails to perform according to the terms of a negotiable instrument. Dishonor is not merely an ethical breach, it is a legal condition that triggers the holder's right to escalate the process under default rules of the UCC. Once a draft or note is presented and not accepted or paid, dishonor is presumed. This activates remedies that convert the holder's claim into an enforceable legal right. The speaker illustrates this with courtroom practice. After tendering an endorsed judgment or other commercial instrument, if the court or opposing party fails to accept or discharge it, they are in dishonor. That dishonor becomes a matter of public record via the transcript, creating a judgment in commerce. This record can be used to perfect a lien, initiate a default process, or pursue enforcement in equity. Importantly, dishonor creates a commercial injury that allows the harmed party to pursue further remedy, such as administrative default, lien attachment, or third-party collection. This is the bridge between commercial procedure and enforcement. It transforms the theoretical power of an instrument into actionable relief by documenting refusal to honor a lawful performance. The transition from presentment to dishonor to enforcement is the essence of administrative remedy under commercial law, requiring no judicial verdict when properly executed. Footnote. This section defines dishonor as a trigger for commercial default and outlines how refusal to accept performance grants the holder the legal authority to escalate enforcement actions. 12. Closing thoughts on enforcement, remedy, and strategic education. The remedy lies in refusing to contract, asserting creditor standing, invoking trust law authority, and compelling proof of claim through strategic use of IRS forms, affidavits, and judicial appointments. The power of knowledge, documentation, and non-consent forms the crux of legal and commercial remedy. Footnote. This final section reaffirms the necessity of education, precision, and procedural assertion in commercial law and public remedy strategy.